Hi, welcome back to this my fourth data update for 2026. Now, I've been reading my data updates, all the more credit for you. And I won't blame you if you say I'm bored, because those updates are probably long and pretty boring in parts. But I also wouldn't take issue with if you raised the fact that they were very US centric. My second data update was on US stocks, my third data update was on US treasuries and corporates. So when are we going to talk about the rest of the world? I hope to remedy that in this post. In this post, I'd like to look at global equity markets and how they did in 2025 in both local currency and US dollar terms. I'd also like to take a snapshot of country risk, and it's only a snapshot because it too shall change over the course of the year at the start of 2026, and close it off by looking at currencies and interest rates in different currencies at the start of 2026. Lots on our plate, so let's get started. Before I embark on looking at the numbers, I think there's a bigger narrative in place. I'm not a political or a macroeconomic analyst, but to me, much of what I've seen happen in politics and economics over the last 40 years has been driven by globalization. For the first 3 decades, globalization was this unstoppable force, and it affected immigration and trade and economics across the world. Since 2008, though, there's a backlash that's developed, and much of what we've seen in politics and economics, including the tariffs from last year, you can attribute to that backlash. I think the 2008 financial crisis broke the trust that people had in institutions, the architects of globalization, and that backlash is changing the way the world order plays out. You're already seeing it play out in Europe and the United States in how the power is shifted. And in many emerging markets, it's brought nationalist parties to the front. So let's take a look at what global equities did in this context in 2025. It was a good year. It was a good year as you look across the world, and what I've done is broken down indices by region, highlighted the best and the worst indices, the best with green and the worst with red. And you can take a look at, even within regions, the wide divergence of returns. Now, one of the problems, though, these are all local currency indices, so to the extent that inflation is driving them, the numbers might not be quite comparable. So one of the things I did to follow up was convert all of these returns into dollar terms, so that not because the dollar is special, but because it's a common currency, and you could look across sub-regions of the world. And this table, you can see how different sub-regions did in terms of market cap, dollar market cap in the aggregate across the course of 2025, and what the percentage change was in the first, second, third, and the fourth quarter of the year, and the percentage change for the whole year. Let's cut to the chase. If you look, and I mentioned this in my first data update for 2026, India was the worst performing market for 2 reasons. One is the Sensex had a below average year, it was up only about 8 point something percent. And if you add to that the depreciation of the Indian rupee, it turned out to be in dollar terms a 3.31% return. If you look at a bunch of the other markets, the returns in dollar terms are actually higher than they were in local currency indices, because those currencies strengthened against the dollar. That was true for much of Europe, and you could see it show up in the returns you'd have earned in dollar terms. Now, another way to look at what happened in 2025 is to look at the market cap breakdown at the end of 2025, coming into 2026. The US still dominates. It's still 47% of global market equities, followed by China and the EU. But if you look just at the change in 2026, the US had a decent year, but it accounted for only 38%. You're saying, what do you mean only 38%? Given that it entered 2025 with roughly 50% of total market cap, it punched under its weight. The EU and China did better than you'd have expected given their weight. So it was a year where you saw at least a partial shift back away from the US to the rest of the world. Now, as you look at those returns, I think there's a broader lesson we need to take away. For much of the 21st century, an investor who invested only in US stocks would have outperformed somebody who followed the textbook. What textbook? Every investment textbook going back 40 or 50 years has advised investors to diversify globally. And in this century, that investor would have lagged a purely US stock investor. And so people look at that data and they say, if for the last 25 years, international diversification has not paid off, why should I do it? Well, you need to step back. First, 25 years sounds like a lot of time, but in stock market history, it's a blink in time. It's not a very long time period. And while it is true the payoff to international diversification has become smaller over time. Why? Because instead of investing, so let's take the S&P 500, you invest in the S&P 500, you're investing not just in US stocks, but in global stocks, because they get such a large percentage of their revenues outside the US. That said, though, I think international diversification still makes sense for most investors, and I think that 2025 was a reminder to look outside your domestic market. So this is not just about the US and the rest of the world, it's about anybody who's invested in purely domestic stock. Look outside. So with that lead in, let's talk about country risk. I write a lot about country risk, and you're probably bored hearing me talk about country risk, but might as well go there. When you look at why countries, some countries are riskier than others, you can trace differences in country risk broadly to 4 factors. One is the political structure. What kind of structure do you have? And broadly speaking, you can break them down to democratic versus authoritarian. Which one's riskier? That's a tough call, because this is, clearly from a freedom perspective, you say I'm going with the democracy, but from an economic perspective, here's the trade-off. Democracy gives you more continuous risk. Things change more frequently. Why? Because that's the nature of a democracy. A new party gets elected in, it's going to change the policy of the old one. So there's less continuity, more uncertainty on a continuous basis. Authoritarian regimes give businesses the benefit of stability. Why? Because the government says, this is the rule, it will not change, and we can promise you that. The problem with authoritarian regimes is the uncertainty when it comes will be large and discontinuous, often with the government shifting, not in the best of circumstances. So what kind of political structure? Second, it is much more difficult to operate a business in the midst of violence, external and internal. So you're in a civil war, or you're in a war with another country, and you're trying to operate a business, you're much riskier. So that exposure to violence becomes a second factor. The third is corruption. Corruption is a hidden tax. It's an implicit tax, and you're paying it to bureaucrats and license grantors. And while many attribute this to cultural reasons, I think you have systemic problems that cause corruption. More corrupt countries are riskier to operate in than less corrupt ones. And finally, businesses operate on legal agreements and contracts and ownership rights that need to be respected, and you need somebody to enforce those rights, courts. If you have a legal system that enforces those rights and follows through on contractual agreements, you are in much better shape as a business than if operating a business in that environment than in one where the legal system is either capricious, you don't know what the rules are going to be and how they're going to be enforced, or it's so slow that by the time you get the legal judgment in your favor, it's too late. So those are the factors that broadly drive country risk. And here I'd like to introduce a structure that I've found useful in thinking about companies, but in the country setting. I think countries go through life cycles. Young countries often have a combination of high growth because they have small economies and they're trying to grow fast, so you can get high percentage growth with high volatility in that growth, right? So it's like young companies. Governance matters a great deal more in young economies because governments can make or break how you move through that cycle. So the country narrative then drives whether the country goes. What's a country narrative? How the country markets itself to the rest of the world. So when you're a young economy, those things matter. As you become a growth economy and a mature, your growth will start to level off. You're a larger economy, it'll become more stable. That's the plus. And your country narrative will take a back seat to company narratives. If you're a company in a very young country, you can tell whatever story you want for your company, but it can very quickly get drowned out by what's happening to the country. As countries become more mature, the company narrative will come to the forefront again. And government policy, it's not that it doesn't matter as much. It should decline in criticality in terms of driving what the country does. And finally, you get into you get to a stable economy, your growth rates start to level off, and then you go into decline. Nobody wants to go into decline. What drives that decline? Well, the industries around which you built your country start to age. Your population starts to age. Aging is the common word here, and the country starts to age as well. Now, what I find interesting about the country life cycle is just in the company life cycle and the human life cycle, nobody wants to get old. They don't act their age. There are young countries which try to act, they want the stability of mature, so they try to create rules that undercut their own growth in the interest of stability. You have mature countries that want to go back to being growth countries again. They push the limits, they create inflation, they don't grow that fast. And declining countries, of course, have nostalgia for the good old days. I mean, I don't want to open up a political firestorm, but I think much of what you're seeing in the US is a seeking of nostalgia for a time when the US was the center of the global economic universe. Now, I don't think you can make it do that, but that's where you see these policies emerging from, is let's go back to the good old days. So with that background, let's talk about, so this kind of summarizes those thoughts: high growth as economies age, and how countries often overreact each. So let's talk about, at the start of 2026, how risk varied across countries. I'm going to start with the simplest, and you might not like this. The easiest and cheapest way to get access to country risk is to look at sovereign ratings. Moody's, S&P, Fitch, among others, rate countries. These are the Moody's ratings for across the globe. And the red, of course, are the lowest rated. The green are the highest rated. The ratings go from AAA down to D. There's no, so basically it looks at the spectrum of countries. Now, as you look at this, there are three things I want to draw your attention to. First, remember that sovereign ratings are built entirely on default risk. You're saying, so what? There are parts of the Middle East especially where your sovereign rating can be good. I mean, take Saudi Arabia as an example, because you have no or low default risk. But as a business operating in the region, you're exposed to other risks that don't show up in the rating. Risk of regime changes, political risk. So I think you got to take it with a grain of salt when you see a good rating. Second, ratings agencies are often accused of being biased, and they have some regional biases. But I think the bigger sin at ratings agencies is they're slow. They're late to the party. So one thing you will notice if you look at countries like Venezuela and Argentina, where big things have happened especially in the last year, you don't see the rating changing yet. Keyword is yet. It takes a while for the ratings agency to reflect changes. So don't be surprised if 2026 is the year that you see both those countries moving. So the caveats are entirely based on default risk, slow to react, downgrades, and when they do change, they're infrequent. In 2025, the highest profile ratings change was actually the ratings change for the US. I wrote about this at the time it happened, where Moody's, which was the last holdout, lowered its rating for the US from AAA to AA1. So there were about 5 ratings changes during the course of the year. Slow to react, not very many ratings changes. You're saying, I'd like something more dynamic, something that reflects the world. And we'll talk about an alternative. Now, of course, the whole point of having a rating and the advantage of having a rating is you can convert it to a default spread, a percentage spread you would pay because of your rating. And that helps in financial analysis and valuation. So one of the ways to get a default spread is if you tell me what your rating is as a country, and I have all the ratings here, I can tell you what the typical default spreads for that rating were on January 1st, 2026. You're saying, how the heck did you get that? Let's take B2, right, where my typical default spread is 467 basis points. I look at two things. One is I look at government bonds issued by countries in either dollars or euros. What's so special about dollars or euros? I can find a risk-free rate in those currencies. So if I can find a Brazilian dollar bond, I can compare to the US dollar risk-free rate, and that difference will become a default spread for Brazil. In the last 20 years, you had a sovereign CDS market, a market where you couldn't go buy insurance against default risk. It's a market set number. And there are 81 countries, different ratings. I can look at the sovereign CDS spreads by ratings class. Collectively, though, this basically is a way of converting the rating to a default spread. And as I said, though, the problem with ratings is they can be stale, they can be a bias. So it would be nice to have a market, and they might not change very much. One of the nice things about having the sovereign CDS market is you can get an updated market set number. Now, don't get me wrong, markets can get this wrong, they can be volatile, but you get an updated number. So if you look at Venezuela and Argentina, you will see that those sovereign CDS spreads have decreased fairly dramatically, at least for Argentina, over the course of 2025. So it tells you that markets are seeing things there that the ratings agency might be seeing but might not be reacting to yet. So that's default risk as one final component of country risk. And this matters to me because in corporate finance and valuation, we're thinking about equity in a business, the ownership right, saying how much is the equity risk in countries. Now, I'm sorry to bore you if you've seen this before, because I do this every 6 months. But here's how I got the equity risk premium at the start of 2026. I started by estimating the implied equity risk premium for the S&P 500. Why? Because I'm very comfortable with the index. I know what's in it. And the way I do this is I estimate, and you saw this in my data update too, by projecting cash flows, solving for an internal rate of return. 8.41% at the start of 2026. That's what people expect to make on an annual basis investing in US stocks. If you subtract out the T-bond rate of 4.18%, you come up with an equity risk premium of 4.23%. And until 2025, that's what I used to do: subtract out the T-bond rate, come up with what I call the U.S. equity risk, which I also made a mature market premium. Well, the ratings downgrade has made my life a little messier. So I start with the 8.41%, but rather than subtract out the T-bond rate, I took the T-bond rate of 4.18%. If you go back to the previous 2 pages ago, if you look at the rating for the US, AA1, the spread, default spread is 0.23%. I subtracted the 0.23% from the T-bond rate. Why? Because I wanted something truly risk-free. And the T-bond now has a default risk component. My dollar risk-free rate is 3.95%. You subtract the 3.95% from the 8.41%. You get an equity risk premium for the US of 4.46%. But a mature market premium now will be lower than the US because of that 0.23%. So I net out the 0.23% to get a mature market premium of 4.23%. So that's the biggest change you would see in the way I do things relative to last year, 2 years ago, 3 years ago, is I now have to make that adjustment up front. So I've got a mature market premium of 4.23%. Then I go look at the ratings, convert the ratings into default spreads, and I do one final tweak. Equities are riskier than bonds. I look up 2 indices. One is an emerging market equity index. The other is an index of emerging market government bonds. And in January 2026, when I look at the volatility of the 2 indices, equities were about 1.52 times more volatile. I'm almost there. I multiply the default spread by 1.52. I get a country risk premium for every country. So if you look at this picture, these are my equity risk premiums by country at the start of 2026. So if you look at the US now is 4.46%. It's not a mature market anymore, at least based on ratings. Denmark 4.23%, Germany 4.23%, Singapore 4.23%, Australia 4.23%. But if you're not rated AAA, you can see that there will be an additional component that I've added on. So in the case of Mauritius, 7.08%. In the case of Spain, 5.78%. And again, I've color. So that is my total equity risk premium, where I take the 4.23% and add that extra component of country risk. So you can see the world, at least in terms of equity risk. So let's turn to currencies. One of my pet peeves when I look at analyses is people mix up currency and country risk. The two kind of start to swim together, and I don't blame them. The two often tend to move together. High risk countries often have very volatile and depreciating currencies, but they're two separate issues. So here's what I want to do. I want to start by looking at different currencies and look at the interest rates on these currencies, clean up, and you'll see what I mean by cleaning up. And then talk a little bit about what it is that causes rates to vary across currencies. Because once we do that, we'll be able to unlock the mystery of why currencies should not drive your valuation and why there shouldn't be a separate currency issue. So I started by looking up every 10-year government bond in local currencies that I could find. There are only about 40 plus countries that have it. So if you look at Colombia has a Colombian peso 10-year bond with an interest rate of about 13%. So with each country though, I took the local currency government bond rate, but I didn't stop there. And here's why. Remember with the US, I took out the default spread from the T-bond to come to a risk-free rate in US dollars. I do the same thing with every government bond here where there is default risk. The exceptions are countries like the Danish krona, the Swedish krona, the euro where I found the German euro, where there is the issuing entity is a AAA entity. So the red portion is the default spread being cleaned out. What's left in the green is my risk-free rate by currency. Now clearly I have the risk of stating the obvious. There's some currencies where risk-free rates are really low, some in the middle, and some where they're really high. What is it that drives differences? It's inflation. Okay? I mean, there's no real reason to dance around this. Inflation is the key driver of differences in risk-free rates. High inflation currencies will have high risk-free rates. Low inflation currencies will have low risk-free rates. And if you had a deflationary currency, you could have a negative risk-free rate, as some countries did until a few years in the late part of the last decade. So I decided to take a look at inflation. And here I use the IMF database, why it's free, where they have actual inflation for last year, expected inflation over the next 5 years. And you can see there are some countries with expected inflation. We take Venezuela, 6-8. No. So with each of these, when you look at the inflation, you can see wide variations in expected inflation. Here again, remember, the IMF, like ratings agencies, slow to adjust to changes in the world. So I'm not sure that the changes in Venezuela are reflected in the expected inflation yet. But those differences in expected inflation will drive rates. So if you look at the red parts, the orange parts of the world, those parts of the world will have high interest rates. They can't get away from it. And by the same token, you look at countries which have low inflation, their interest rates will be much lower. One thing to note, one reason I don't lose sleep over the Fed chair and how the Fed's going to behave is you really can't move T-bond rates below 4.5%. And I talked about 4%, and I talked about this in the last session. If inflation stays at 2.5, or 3%, inflation will end up driving difference in rates, and therein is the answer to why currencies should not matter. Just to flesh out how I adjust risk-free rates and how risk-free rates and inflation play out. Once you make that connection that inflation is the driver of risk-free rates, we now have an opening to estimate a risk-free rate in any currency. Remember, the government bond approach worked only when you had a country which had local currency government bonds. 130 countries out there, and currencies have no local currency government bond. How do they borrow? They borrow from a bank, they borrow from the IMF, the World Bank, wherever they borrow. Here's a way you can get around that. Let's say you wanted a risk-free rate in Egyptian pounds. You can't find a 10-year Egyptian pound government bond rate. But you can get an expected inflation rate of 7.78%. That's actually the IMF estimate, and 2.24% for the US. The risk-free rate in Egyptian pounds is, if you want, and I'm going to use a shortcut here, is to take the risk-free rate in US dollars, the 3.95% we got earlier, and add to it the difference in inflation between the two countries. It's a shortcut because there is a slight compounding effect. Now, if you read the post that accompanies it, you can see what that compounding effect is. It gives you 9.58% from 9.49, and you can see that described. So where you take 1 plus the US dollar risk-free rate, but the essence of the argument here is if differences in inflation drive risk-free rates, then you should be able to get a risk-free rate in any currency. You think, but what if I get the inflation rate wrong? Don't worry, you're going to be okay. Strange thing to say, right? You're going to be okay as long as you're consistent. Consistent in what sense? Well, remember, inflation plays out not just in your interest rates and your discount rate, it also plays out in your revenue growth and your cash flows. In fact, here I have a picture of an intrinsic valuation where the numerator reflects where the cash flows come from, revenue growth, margins, and how much you reinvest. and what your discount rate comes from, which is a cost of equity and a cost of debt. If you have a high inflation currency, well, your cost of equity and your cost of debt are going to be high. Your cost of capital is going to be high. You're saying, this is terrible. If you have a high inflation currency, your revenue growth should reflect that high inflation. And your reinvestment should reflect the fact that you're really not growing that much. You don't need to build those extra factories. When you use a high inflation currency, you will have much higher cash flows and a much higher discount rate. When you take that same company and you revalue with a low inflation currency, business is still the business, the reinvestment is still the reinvestment, you'll have a lower set of cash flows and a lower discount rate. The net effect on value, if you do this right, should be zero. It's a currency invariance proposition. I won't call it a theorem that will require a proof I'm incapable of, but it's a proposition. It actually is a huge relief because it means you can take any company and value it in any currency, just be consistent. So the effects of inflation cancel out. A project that has a positive net present value in US dollars should have a positive net present value in Egyptian pounds. A company that I valued in Egyptian pounds, if I revalue in US dollars, should have exactly the same value. It is actually frees you to pick a currency and move on rather than sit there and try to debate what currency is best to do your analysis in. Now, don't get me wrong. I'm not saying currency inflation doesn't matter. In fact, 2 years ago, almost 3 years ago, towards the end of 2022, when inflation had come back after a decade of being gone, people had no idea what to do with it. So I wrote a piece on how inflation can affect different companies differently. Inflation is value neutral to a company. In other words, changes in inflation are value neutral to a company if they can pass inflation through their pricing power. So I argued that companies with pricing power can live with changes in inflation much better than companies without that pricing power. You say, but you told us that currencies don't matter. No, that's not what I said. I said, once things have happened, if your company is a good company, I can't make it a bad company by changing currency. If it's a bad business, I can't make it a good business. So currencies can change value as they change over time, but once at a point in time to value a company, choosing a different currency shouldn't alter the process. So what's the bottom line? Well, globalization gets a blowback, and lots of people want to go back to the good old days. Now, we're all connected in ways we can't disconnect. So much as you see the backlash, we're not going to go back to the 1970s and the 1960s. Now, you might disagree with me on how I measure country risk, and I take a lot of shortcuts. I'm a pragmatist. That's fine. You can come up with a different measure, but what I think is not debatable is that risk varies across countries and you need to incorporate into your decision making. I hope this session has helped you kind of understand the drivers of country risk and how they play out in the numbers you see. But it's a process, and I think each year we learn something new about country risk and how to deal with it. I hope you found this session useful, and I thank you very much for listening.